All right, everyone, get ready for a deep dive. Today, we're all about financial assets.
Yeah, untangling that whole risk and return thing.
Figuring out how they work together and what it means when you're actually, making those investment decisions.
Right, like everyone wants the big returns, but how much risk are you willing to take on,
Exactly.
right?
So to make it even more interesting, we're throwing some very different things into the mix.
Oh, yeah.
We're talking gold, the classic safe haven,
Gold reliable.
versus
Yeah.
cryptocurrencies,
New kid on the block.
shaking things up.
It's a bit of choose your own adventure, isn't it?
I like that, yeah. Like a leisurely stroll through a park.
Yeah.
Really well.
Versus like trekking through the wilderness.
Ooh, I like that.
Both can be rewarding, but the experience, the potential dangers are totally different.
Yeah, big time. Okay, so let's start with gold.
Sure.
It's often called the risk-free asset,
Yeah.
but I feel like there's more to it than that.
Right.
What's the real deal with gold?
Well, the idea of it being risk-free comes from, way back when, thinking about its historical role as a store of value
Right.
for centuries, right? It's been that safe haven when things are uncertain. And its price is relatively stable globally.
Right.
And it's not tied to, like, any one country's economy or political system.
But gold prices do fluctuate. Right.
Yeah.
We see those headlines all the time.
That's
Does
what-
that mean it's as risky?
Here's the thing. Volatility and risk aren't always the same.
Oh, okay.
Yes, gold prices move up and down, but those swings,
Yeah.
they tend to be pretty small compared to like other assets.
I see.
And even when, everything's going haywire in the market, gold usually holds its value better than other investments.
Ah, interesting. It's like that, what is it, that sturdy umbrella that keeps you dry
Yeah,
when
exactly.
it suddenly starts pouring.
Exactly.
So it's more about like just riding out those short-term changes, knowing that in the long run, it's probably going to be okay.
Exactly. Yeah.
All right, so let's jump to the other end of the spectrum. Crypto
Right.
definitely captured a lot of imaginations,
Yeah,
but it's got that reputation.
definitely.
Some people, they see it as digital gold,
Yeah.
but others think it's a bubble about to burst. Is that comparison to gold even valid?
There are some similarities, I'd say.
That's
Like
good.
both gold and Bitcoin, they're limited in supply, right?
Right.
That's key for their value. And both can be used as payment, though
Yeah.
gold is much more widely accepted at this point.
That's true. But Bitcoin's track record is way shorter than gold's.
Right, yeah. Huge difference.
That seems like a big deal.
Gold's been around for thousands of years. Bitcoin's barely a teenager.
Wow, that's a good point.
So that lack of history, it means there's a lot more uncertainty.
I see.
The price, it swings wildly based on speculation, news, even like tweets from certain people.
It's so unpredictable.
It's like a high-performance sports car, exhilarating, but
Yeah.
definitely not for the faint of heart.
Yeah, I get that. So, okay, big potential returns with Bitcoin, but you're also taking a much bigger risk than gold.
Yeah, that's the trade-off.
Okay. And it's important to remember there's way more than Bitcoin in the crypto world.
Oh, yeah, it's a whole universe out there.
Like a whole universe of altcoins, each with their own risk and potential.
Absolutely.
That's what gets me. The sheer variety.
It is a lot.
It's overwhelming.
Yeah.
You got stable coins, smart contract platforms,
Yeah.
tokens for like everything. Where do you even begin?
It can feel like drinking from a fire hose for sure, but let's break it down.
Okay.
Think of it like a city. Stablecoins are like your reliable banks.
Yeah.
They want to keep a stable value, usually pegged to like the US dollar.
Okay.
They offer a way to get into crypto without those crazy price swings.
So stable coins are for those folks who want to test the waters but not like jump in head first.
Exactly, yeah.
Like that.
Then you have, the smart contract platforms like Ethereum or Solana. These are like the city's infrastructure. They're the foundation for all these decentralized applications. Financial tools, games, even virtual worlds.
Wow.
So potential for growth, but probably a long-term play, right?
Right.
Yeah.
That makes sense. Yeah. They're still evolving.
Yeah.
And their success depends on a lot of things, like adoption by developers and users.
Right.
And then, of course, you have the generic tokens, the ones that promise you'll be rich, but
Yeah.
a lot of hype and uncertainty.
A lot of hype.
This is where the risk really goes up, right?
Oh, yeah, for sure.
They're often tied to startups or projects that are like really early stage.
It's like investing in a brand new restaurant,
Oh, yeah, I get that.
It could be the next big thing, or it could close down in a few months.
So you really have to do your research here.
Yeah, big time.
You got to know what you're investing in
Absolutely.
before you jump in.
Even then, acknowledge that a lot of these projects fail.
Yeah, that's a good point. No, I can't ignore this.
Yeah.
Passive income in crypto
Right.
sounds so tempting.
Oh, yeah.
But it's
Right.
got to be too good to be true.
Well, yeah, the idea of earning passive income on your crypto is appealing.
It is.
But those high yields, they usually come with, some hidden risks.
Yeah.
The projects might not be sustainable, or the market could shift and wipe out your gains.
That's a good point.
It's like chasing a mirage. It looks good from afar,
Oh, yeah, I see that.
but as you get closer, it might disappear.
So a healthy dose of skepticism
Yeah,
and a clear understanding of the risks
absolutely.
when
Yeah.
it comes to passive income in crypto.
Yeah.
Okay, that makes sense.
Yeah.
And that brings us back to this core idea, right? Risk and return.
Exactly.
It's not just about chasing the biggest gain.
Nope.
It's about finding what's right for you.
Yeah, that balance.
And that's where diversification comes in, right?
Yeah, like building a well-rounded meal. You want variety,
I like that.
different assets in your portfolio, each playing a role.
I love that. Okay, let's turn this to our listener. Think about your financial goals. What are you trying to achieve?
Mm-hmm.
And how much risk are you truly comfortable with?
Right, that's key.
Are you a thrill seeker, okay with those big swings? Or do you prefer a smoother ride?
It's all about your comfort level.
Yeah, that's a good point. Because even with diversification, you can't get rid of risk completely.
Nope.
It's about finding that sweet spot, the level of risk that lets you sleep at night
Right.
while still giving you the potential to reach those financial goals.
Exactly. It's funny how we categorize investments like they're characters, right?
I like that.
You got your newcomers, the exciting ones, your steady stalwarts.
And the ones that just feel like comforting, like an old friend,
Exactly. And that brings us to real estate.
Ah,
An asset class that's like the cornerstone of wealth building for generations.
it feels so solid.
Yeah.
Like literally you can see it, touch it,
Right.
you can even live in it.
It's not some number on a screen. There's that tangible aspect to it that, a lot of investors are drawn to.
Absolutely. And it's not just about owning your own home.
Oh, no, not at all.
There's all sorts of ways to get into real estate investing.
Yeah, you could be a landlord, manage rental properties. You could invest in REITs if you want something more hands-off.
Right.
Or even check out crowdfunding platforms for specific projects.
Okay, so let's unpack those.
Mm-hmm.
Starting with buying a property directly.
Okay.
What are the things to think about risk and return-wise?
Well, location, location, location.
Of course.
They don't say that for nothing.
Right.
Properties in high demand areas, strong rental markets, they tend to go up in value and they generate consistent cash flow.
But those prime locations, they're expensive.
Yeah, the barrier to entry can be high.
And not everyone's dropping millions on a beachfront condo.
True, true. But think of it like, buying a rare wine.
Ooh, okay.
You pay a premium for something limited, in demand.
Okay, that makes sense.
Higher cost often means higher potential returns.
What about the risks of owning property directly? We talked about values fluctuating. Is that a big concern?
It's something to be aware of.
Okay.
Real estate markets, they go in cycles.
Right.
Values can go down. Interest rates, the economy, even neighborhood changes can affect your investment.
So it's not just about picking the right property. It's about being ready for the market's ups and downs.
Exactly. And then there's other risks like surprise repairs,
Oh, yeah.
difficult tenants, changes in regulations.
That affect your rental income?
Exactly.
Being a landlord is more than just collecting rent checks.
Oh, yeah. It's like running a small business.
It is. It is. Okay, so for those who want real estate without the hands-on stuff, there's REITs.
Right.
Tell me more about those.
REITs, those are real estate investment trusts.
Right.
They own and manage properties that generate income.
Right.
Think apartment buildings, shopping malls, office complexes.
Right, the steady income kind of stuff.
Exactly.
So instead of owning one property, you're buying into a company that owns a bunch of them.
Yeah. Diversification without the landlord headaches.
And you can buy and sell shares like any other stock, right?
Yeah, traded on the stock exchanges. You got that liquidity.
That flexibility is nice, but like stocks, REIT prices can fluctuate too.
Yeah, market conditions and all that.
So the risk is somewhere between owning directly and bonds.
Yeah, I'd say so.
Okay, now what about those crowdfunding platforms?
Crowdfunding, yeah, those have opened up some cool
It
possibilities.
seems like a way to get into real estate with less money.
Exactly. They pool money from a bunch of investors to fund specific projects.
So you're kind of like a fractional owner in that venture.
Yeah, exactly. You can get involved in stuff that would normally be out of reach.
But there's got to be risks with any new platform.
For sure.
What are some of the downsides?
Full transparency is a big one.
Okay.
Got to do your research on the platform itself, their track record, how they check things out, how they pick the projects.
So don't just go for the flashy presentation.
Yeah. Got to dig into the details, assess the risks.
Right, right. And is it easy to get your money back if you need to?
Ah, that's another thing.
Okay.
Crowdfunding investments can be illiquid.
Meaning,
You might not be able to cash out quickly.
so patience is key. Long-term mindset.
Yeah, like owning property directly.
Makes sense. All right, so we've covered a lot with real estate.
You have.
Seems like there's a way to invest in it for anyone, any risk level.
That's what's great about it, yeah. Whether you want stability and appreciation or the diversification and liquidity,
Or those targeted opportunities with crowdfunding.
there's a path for everyone.
And, of course, diversification is still important.
Always.
Don't put all your eggs in one real estate basket, no matter how good it looks.
Wise words.
Now, before we move on, I want to go back to something you said earlier.
Yeah.
The emotional side of owning a home.
Right. That's something unique about real estate, isn't it?
I think so.
For a lot of folks, a home is more than just, bricks and mortar.
It's emotional.
It's about comfort, security, belonging.
It's about building a life, memories, putting down roots.
Yeah.
And those feelings affect our financial decisions.
They do, but we got to be aware of those emotional biases.
Oh, that's a good point.
Sentiment's important, but shouldn't overrule good financial sense.
So how do we balance those desires with our goals?
Honestly, start with honesty.
Okay.
Ask yourself, why am I doing this?
Right.
Is it just about the money, or is it about those emotional rewards of owning a home?
That's a great question. And once you know your priorities, you can choose the best strategy.
Exactly. Rental property, REIT, crowdfunding, there's an approach for every.
To navigate those emotional and financial sides of real estate.
Exactly.
Okay, so we've dug into gold, explored the wild world of crypto, and even built some foundations with real estate.
Right, quite a journey.
But no financial asset adventure is complete without talking about stocks and bonds.
Ah, yes. The classic duo.
They're like the core of a diversified portfolio.
Yeah, you could say that.
But I think for a lot of people, they can be kind of intimidating.
I get that.
All that jargon, complex strategies, you can make your head spin. So let's break it down, starting with stocks.
Sure.
What's the simplest way to understand, what they actually are?
At their heart, stocks are about ownership in a company.
Okay.
When you buy a share, you're basically becoming a part owner with a claim on its assets and earnings.
So company does well, my shares go up, I profit.
Exactly.
Company struggles, my investment takes a hit.
That's the risk.
Classic risk-reward thing.
Yep, and that's why stocks are seen as riskier than, say, bonds.
Right, right.
But with that risk comes the potential for those bigger returns.
Higher risk, higher reward.
Exactly.
Okay, so diversification is key with stocks, right?
Oh, absolutely. Don't put all your eggs in one basket, especially one that's, a bit wobbly.
Got it. Spread it out. Different companies, sectors, even countries.
Exactly. That way, if one stock tanks, it doesn't take your whole portfolio down with it.
All right, makes sense. Now let's talk bonds.
Okay.
They're different, right? More like loans.
Yeah, think of it that way. You're lending money, not owning a piece.
To the issuer.
Right. Which could be a company, a government, even a city.
And they pay you interest, right?
Yep, regular interest payments called coupons.
Okay.
And they repay the principal when the bond matures.
So bonds are generally seen as safer, more predictable.
Yeah, they tend to be. You're the lender, so you have a higher claim if things go south. And those interest payments, they provide a steady income stream.
But they're not completely risk-free, are they?
Nothing is, really. The main risk with bonds is default.
Default meaning?
They can't make the payments.
Oh, okay.
So research the issuer, make sure they're trustworthy.
Got it. And bond prices can fluctuate too, right?
Yeah, things like interest rates, the economy, all that jazz.
So stocks are ownership, higher potential returns, but riskier. Bonds are loans, more stability, but maybe lower returns.
You got it.
How do you choose which one is right for you?
That's where your risk tolerance, goals, and time horizon come in.
It's personal.
Yeah, finding that balance between stocks and bonds to build a portfolio that fits you.
Like customizing a recipe.
I like that.
Some folks want that spicy, high-growth portfolio, lots of stocks. Others want something more balanced, milder, more bonds.
It's all about what you're comfortable with.
And that perfect mix can change over time, right?
Absolutely.
Like a younger investor with more time, they can handle more risk.
Yeah.
Someone closer to retirement, they might want stability and income.
Makes sense.
Okay, let's dig a little deeper into stocks. There's so many different strategies.
Oh, yeah. It's a whole world.
Value investing, growth investing, momentum investing. How do you even navigate that?
Well, first, you got to know yourself, your style, your risk tolerance.
Okay.
Are you patient, happy to wait for long-term growth, or do you like to be more active, trying to, time the market?
Right, right.
Yeah.
And then there's that whole active versus passive investing debate.
The age-old question.
Can you break that down?
Active investors, they think they can beat the market by picking stocks or timing trades.
Okay.
Passive investors, they usually go for index funds or ETFs.
Yeah.
They track a specific market benchmark like the S&P 500.
So it's like trying to outsmart the casino versus just betting on the house to win overall.
I like that analogy. And statistically, it's tough to consistently beat the market.
So passive investing is often recommended.
Especially for long-term investors, yeah. Index funds and ETFs, they offer diversification, low fees, and a solid track record.
Makes sense. It's
Yeah.
like having a team of experts crafting that perfect meal rather than trying to be a master chef yourself.
Exactly.
Right, let's bring it back to bonds. They might seem less exciting, but they're important.
They are. That stability is key.
It's like the reliable partner in the relationship.
Provides that steady income, that peace of mind.
Okay, so we hear about different types of bonds. Government bonds, corporate bonds, municipal bonds. What's the difference?
Government bonds are issued by, well, governments, and they're usually seen as the safest.
Okay.
Corporate bonds, they're from companies, higher risk of default, but also potential for higher returns.
I see.
Municipal bonds, they're from state and local governments, often come with tax advantages.
So, got to understand the risks and potential returns of each type before investing.
Absolutely. And think about the maturity date, too.
Maturity date?
When you get your principal back, long-term investor, go for longer maturity.
Yeah.
Need liquidity sooner. Shorter-term bonds might be better.
So align your bond investments with your goals and time horizon.
Exactly.
This has been awesome. We've covered so much.
It has been a deep dive.
From gold to crypto to real estate to stocks and bonds.
A real whirlwind tour of financial assets.
The biggest takeaway.
Knowing yourself, your risk tolerance, your goals, your time horizon.
Because there's no one right way to invest.
Nope, it's about finding that perfect mix that lets you sleep at night.
While still giving you a chance to reach your financial dreams.
Exacts.
Well, I think we've given everyone a lot to think about.
I hope so.
Understanding risk, exploring different assets.
It's all about building that financial future.
It is. Thanks for joining us on this deep dive. Keep exploring, keep learning.
Keep those financial wheels turning.
And until next time, happy investing, everyone.